Bubbles stock market close show for Monday, October 27th, 2025, 6:06 p.m. Eastern Standard Time, coming at you after hours for the Bubbles show. Now we got the markets here. We see all-time highs in the stock markets, VIX moving down, oil. What is oil doing? Let's look at a daily chart. It's a monthly chart. Before we move on to monthly chart, I just want to really have you take a look. See this, see this, see this, see this. Looks strong, doesn't it? It is. It does look strong. It looks strong. See this? Looks like it's going down. And it doesn't mean just because it looks like it doesn't mean it has to, but that's definitely what it's looking like. So, oh, daily. That's right. Markets daily. All right. Now we're opening again, and 3 out of 4 are opening at the top of their bull candle, and 1 out of 4 is opening at the bottom of a bear candle. But in relationship to the whole month, it's still up. And because of this right here, kind of because of the way that looks, the way this looks, could this and this here, the way that, yeah, it could a bit of support be built in this area. It looks like it. So so that it would appear that we are moving into that it's at least possible that we're moving into bullish territory again. And what's interesting with that is this is the Buffett indicator, and my general understanding of this is like a Warren Buffett, hence Buffett indicator, Benjamin Graham, value in investing, one number that can give us a quick summary of is the stock market overpriced, fair value, good deal. And it's telling us now overpriced. Now, I'm sure there's some Warren Buffett aficionados that would correct me on that, and please do. But that's just my general how I'm seeing it. I think I understand it enough to know that it's telling us overvalued. And then we have the MMRI that doesn't measure value and it doesn't time a crash, but it attempts to measure risk. And that's a nuanced thing. I believe that's a nuanced thing to understand because, like, what would be the difference between a crash and risk? A crash is risky, or there seems like there's this nuance here, and there is. And I feel like how I've been able to use this the most, to the most benefit at least, and it was the stock market would be going down, and I would look at the MMRI. And if the MMRI was overall going down while the stock market was going down, generally that amount of down that the stock market was having wouldn't last long, and it would usually come back. Stock market, when it came back really strong, and it wouldn't take like that long. So um, now I I remember times when the MMRI was really high in the danger zone up here in extreme, but I never saw it crash when it was or have a major correction when it was in there. What happened is before there was anything, the MMRI started coming back down. And so it wasn't in that area that long, but we see it here. It was in that area, 325. And so there's a lot of information in out there, and I think one thing that's worth bringing to the bubble stock market close show is in at least an idea for us to ponder as individuals that perhaps the actual markets can change faster than the indicators keep up with it, and the now and not just the indicators, because there's something deeper than indicators. Uh, the stock market fundamentals, internals, dynamics change can change faster than people, traders, make indicators for, or take action on, or get educated on. So, for example, things can happen like, let's say there's some second or third order of effects after computers take over doing XYZ process in the actual plumbing of the stock market, like the Nasdaq and the whatever, the Nasdaq and the New York Stock Exchange over there at wherever they do, Chicago, wherever these stock exchanges are. You know, if they're doing stuff by hand and they stop writing stuff by hand, they put it on, use a computer. And then over time, the computer replaces the person that was even writing. And there's these different shifts, even if it's um, not a person being replaced. It's just the person being replaced is just an example that things change, different dynamics change, and they could have effects on how they flow. If it's the actual plumbing, the systemization of the stock market, if the actual system or the plumbing's changing, then of course you're kind of going to get a different result, even if it's a nuanced one. And I think that because a lot of the stock market wisdom that is spoken of and that we tend to gravitate towards is a lot of older things, the older wisdom of like Benjamin Graham, value investing. And don't take it the wrong way. I'm not saying we shouldn't be. I'm here showing you the Buffett indicator. I look at it every day. And I'm reading reading the Intelligent Investor daily right now. So, but I think it's possible that, for example, Benjamin Graham is not alive right now. So if he was alive right now, he would probably come out with another edition of his book, and he would probably change some things around because he'd probably say like, "Holy crap, look at this high frequency trading and this and that and um, a passive bid from XYZ, I don't know, retirement plans, wherever this passive money flow is coming from. All these things are dynamics happening that weren't really in play 20 years ago, 15 years ago, for some stuff, not even like 5 years ago or whatever it might be. So I think that need to, I think that I prefer to, and I'm going to recommend for you to at least ponder if it might be of value to you for us to just be open to this idea that maybe the tools that we're using don't have the same, um, maybe we need to read them a different way in order to get the same amount of value out of the tool. Maybe because what we're measuring, the dynamics of the thing we're measuring has shifted, that it's possible if we're going to use the old tool, that at least we should be open to number one, that maybe the tool doesn't work anymore or it needs to be revised. Or number two, if it still works and it's given us data, that maybe that data is not actually a measurement of what we thought it was measuring. Maybe it's a measurement of something else because of some sort of modification that happened in the stock market. And I think that possibly, I would imagine that constant wondering and pushing into questioning the validity and resourcefulness of our own ideas about the tools that we're using to engage in the endeavor we're attempting to engage in, which is basically trying to come up with good decisions based on incomplete information, trying to come up with profitable decisions on incomplete information. And it is a fun game. If it was not such a fun game, there wouldn't be so many of us playing it. So with that, ladies and gentlemen, that's the close show. We hit all-time new highs, and let's keep our minds open to being flexible of having adaptability with the tools that we use and not only the tools that we adaptability, not only with the tools, but when we're using the tools to be adaptable enough to look at is this actually measuring something different now because something has changed, or is it not? Is it still measuring the same thing? All right, aloha.